Welcome to the Opening Bell Report.
Um, if you've glanced at any financial news lately, or even just scroll through your feeds, you probably have a very specific image in your head when it comes to traditional automakers.
Right, the usual doom and gloom.
Exactly. You're likely picturing these legacy companies that are just struggling, right? Heavily weighed down by the whole electric vehicle transition, bleeding cash, and generally just sort of losing the race to the future.
Yeah, that is definitely the prevailing narrative right now.
But what if that narrative, the one you are seeing every single day, is actually masking one of the most compelling value plays in the entire market?
It's a huge what if, but the data really backs it up.
It does. And today's deep dive is going to flip that gloomy narrative completely upside down. We are looking at a really fascinating analysis report today. It's titled, "Should You Buy Ford Stock Now? The Bull Case Explained." And our mission for this deep dive is to look right past those negative headlines you're seeing and unpack a hidden, unrecognized value story that the broader market seems to be, well, completely ignoring.
And just to set the scene for you listening, we are talking about Ford Motor Company, ticker symbol F,
Right.
which is currently sitting right around the $12.15 price range.
And at $12, I mean, it really is the classic setup for a contrarian investment, isn't it?
It absolutely is. You have Wall Street entirely fixated on these near-term electric vehicle struggles, and they're aggressively punishing the stock for it.
Okay.
But when you strip away the market sentiment, the emotion of it all, and actually look at the underlying fundamentals presented in this analysis report, it tells a remarkably different story.
A completely different story.
Right. The bull case essentially suggests that this heavy discount the market is applying to Ford right now isn't a glaring red flag. It's actually a highly compelling entry point.
Especially if you're a value or a dividend-seeking investor.
Exactly.
Okay, so let's unpack this.
Yeah.
Because when a legacy century-old company like Ford dips down to $12 a share, instinct tells you, something is fundamentally broken.
Sure. It feels risky.
Yeah. So walk us through why this analysis report is looking at all this gloom and boldly calling Ford a buy.
Well, to understand the bullish perspective, we really have to start by addressing the massive misconception that's driving the stock price down in the first place.
Okay.
The market, and certainly the financial media, are entirely focused on Ford's EV arm. They call it the Model E division.
Right, Model E, that's where all the bad press is coming from.
Exactly. That is where all the negative headlines are originating. The cash burn there is highly visible.
Right.
But what the underlying financials reveal, and this is really the first major pillar of the bull case in the report, is a division called Ford Pro.
Ford Pro.
Yes, this is Ford's commercial division. And the data suggests the market is entirely mispricing its value.
Right, because Ford recently did something really smart structurally, didn't they?
They did. They separated their business into 3 distinct reporting units to give investors more transparency.
So you have Model E taking all the heat in the press, but then you have Ford Pro, which is essentially this hidden juggernaut quietly dominating the industry.
Hiding in plain sight, really.
Yeah. But I have to ask, what makes Ford Pro so special? Why isn't it just a regular low-margin division selling metalwork trucks to plumbers and delivery companies?
What's fascinating here is that Ford Pro is definitively not just about selling metal boxes on wheels to businesses.
Okay.
The analysis report highlights that Ford has built an undisputed leadership position in commercial vehicles by creating a highly sticky, high-margin ecosystem.
Sticky meaning hard to leave once you're in it.
Exactly. We are talking about integrated telematics software, commercial charging networks, and dedicated predictive fleet servicing.
Wow.
It is an end-to-end logistics and management platform for commercial fleets. And this is a crucial point from the report. Competitors simply cannot easily replicate this ecosystem overnight.
It's a massive moat.
It's an incredible competitive moat.
When you think of a Ford F-150, you typically think of a guy hauling lumber or tools around.
Yeah, it's the classic image.
But what you're saying is we should actually be looking at it as a rolling computer node in a corporate logistics network.
That is exactly how you have to view it now.
That completely shifts how you value the company. It's almost like the Apple ecosystem, right?
Oh, that's a great comparison.
Yeah, once a business relies on Ford software to track their drivers, manage their overnight charging schedules, and predict maintenance before a truck even breaks down.
The switching costs are just too high.
Exactly. The switching costs to move their entire fleet over to a competitor become astronomical. They are locked in.
That is a perfect analogy. The stickiness of that software and service ecosystem is exactly what drives those margins up.
Right.
And the financial reality of that commercial ecosystem is staggering. The analysis report identifies Ford Pro as the true financial backbone of the entire company right now.
The backbone.
Yes. It is a highly efficient capital-generating machine. And here is the critical dynamic to understand if you're looking at the stock.
Lay it on us.
The massive profits being generated by the Ford Pro division are literally subsidizing the rest of the company's costly transition into the electric vehicle space.
Subsidizing the EV losses.
Exactly. Without Ford Pro, the narrative would be exactly as bad as the headlines claim. But with it, you have a massive profit anchor stabilizing the entire ship.
Okay, so Ford Pro is a cash machine. I get that. But I'm looking at the overall financial statements from the report right now, and the bottom line is still written in bright red ink.
It looks bad on the surface, yes.
Right. If they're making all this money on commercial trucks, where is the leak? How do we reconcile this incredibly profitable commercial juggernaut with the fact that their official net income looks so ugly on paper?
Well, if we connect this to the bigger picture, you have to separate the actual cash coming in the door from the official accounting rules.
Okay, accounting versus cash.
Right. Because over the last year, the report shows Ford generated an absolutely massive $187.3 billion in revenue.
Billion with a B.
Yes. That is top-line sales. The sheer volume of money transacting is astronomical.
Almost $190 billion in sales.
Right.
But then you look at their GAAP net income, the official accounting profit, and it's negative.
Right.
So to a casual observer, to anyone just pulling up to the stock ticker, that looks like a disaster.
It does. It really does look terrible. But let's break down exactly why that is, according to the analysis. That negative GAAP net income is largely driven by deliberate strategic EV write-downs and massive one-time impairments.
Impairments. Okay, let's demystify what an impairment actually is for the listener.
Think of it like this. If Ford spent $1 billion a few years ago building a specialized EV factory, right?
Right.
And today they realize the consumer demand for EVs isn't going to make that factory as profitable as they initially projected.
Because EV demand is softening.
Exactly. Accounting rules force them to take a massive write-down on paper today. It makes it look like they lost $1 billion this quarter.
They didn't write a check for $1 billion yesterday?
No. In reality, the actual cash left the building years ago.
Ah, I see.
It's an accounting adjustment to reflect current asset values, but it does not erase the fact that the underlying day-to-day business still drove $187.3 billion in real revenue.
So the accounting rules make it look like they're bleeding to death right now, but the actual cash registers in the dealerships and the commercial fleet offices are ringing nonstop.
Precisely.
And that disconnect creates a really wild valuation metric. The analysis report highlights the price-to-sales ratio, or PS ratio.
This is where the value play really shines.
Yes, and for those of you listening who might not look at stock metrics every single day, the price-to-sales ratio basically tells you how much investors are currently willing to pay for one single dollar of a company's sales.
Right.
According to the data, Ford is trading at a rock-bottom PS ratio of roughly 0.26x.
Yes, 0.26x. To put that in plain English, right now, investors are paying roughly 26 cents for every single dollar of sales Ford generates.
That is wild.
It is. The underlying argument in the report is that at 26 cents on the dollar, the stock is effectively priced for collapse.
Priced for bankruptcy.
Essentially, yes. The broader market is pricing Ford as if it's heading for bankruptcy, completely ignoring the reality that it's earning billions in top-line revenue and sitting on a deeply entrenched commercial monopoly with Ford Pro.
To put that 0.26 ratio in perspective for you, an average healthy company in the S&P 500 might trade at a PS of 2 or 3.
Right, 2 or 3 is normal.
Meaning you pay $2 or $3 for every dollar of sales? High-flying tech companies routinely trade at 10.
Oh, easily.
So at 0.26, the market isn't just saying Ford is struggling, it's practically pricing them for a garage sale.
Exactly. The pessimism is entirely baked into the price at this point. That leaves very little room for further disappointment, but massive room for upside if the narrative even slightly improves.
But let's play devil's advocate here. Let's look at this critically.
Sure.
You say it's a garage sale, and sure, the commercial side is great, but they are still burning billions on battery plants and EV research.
Yeah.
If a macro recession hits tomorrow and commercial truck sales slow down across the board, isn't that dividend the very first thing on the chopping block?
That's a very fair concern.
If they're in this awkward, messy transitional phase, why should you, the listener, step in front of this train right now? Why not just wait until the dust settles and the EV transition is actually finished?
That is the ultimate investor's dilemma. And it's exactly why the stock is cheap. Why step in front of the transition?
Right.
Well, the bull case from the analysis report provides a very compelling answer to that hesitation. It's the dividend.
The dividend.
Yes. You mentioned the dividend being on the chopping block, but the data points to a strategy of getting paid to wait. At the current price levels of around $12.15, Ford boasts a dividend yield of approximately 4.94%.
We are talking about a nearly 5% yield.
It's almost 5%, yes.
But is it safe? Because when you see a 5% yield on a stock that's been beaten down like this, you immediately think it's a value trap.
Of course you do.
You think they are going to cut that payout next quarter just to fund the EV losses.
And that is exactly what the broader market fears. But the underlying cash position presented in the report counters that fear quite strongly.
Okay, how so?
It acknowledges that, yes, Ford's free cash flow is currently being heavily pressured. They are undertaking massive capital expenditures, or CapEx, to build entirely new battery plants and retool their legacy factories.
Brutally expensive.
It is a brutally expensive phase in their history. However, the data reveals that Ford's core automotive cash position remains incredibly healthy.
So the legacy stuff is paying the bills.
Exactly. The legacy internal combustion business and the Ford Pro commercial business are generating robust enough cash to safely sustain this dividend payout, even while the EV division burns capital.
I see. So the argument here is essentially a waiting game. You are collecting a 5% annual yield just to hold the stock, but you have to trust that management will actually turn off that CapEx faucet in time and fix the EV burn rate.
Right. You are being compensated to sit on your hands while the transition happens.
That makes a lot of sense.
That's the crux of it. And that flows perfectly into the next major revelation in the financials, which is the sheer volume of cash moving through this business on a daily basis.
It's massive.
It raises an important question. If the bottom line is ugly and they are paying this dividend, where is all the rest of the money actually going?
Right.
The metrics in the report show that Ford is generating roughly $21 billion in operating cash flow.
$21 billion.
That is about 11% of its total sales.
That is a monumental amount of cash being thrown off by the day-to-day operations of just selling cars, trucks, and servicing commercial fleets.
It really is.
But if they have $21 billion in operating cash flow, why is the stock sitting at $12.15? Like, where's the bottleneck in the pipes?
The bottleneck is the massive investment cycle they are in right now. We have to differentiate between operating cash flow and free cash flow.
Okay, break that down for us.
Operating cash flow is the money generated by the actual business operations, literally selling the cars.
Right.
Free cash flow is what is left over after the company pays for its capital expenditures, building new factories, upgrading equipment, that sort of thing.
Got it.
Right now, a massive chunk of that $21 billion in operating cash is effectively trapped.
Trapped by the transition.
Exactly. The money comes in from selling F-150s, and it immediately goes right back out the door in the form of heavy R&D and CapEx to build the physical infrastructure for an electric vehicle future.
So they are sacrificing today's free cash flow to build tomorrow's factories.
Yes.
They are planting seeds for a harvest that is years away, which is why Wall Street, which thinks in, 3-month quarterly cycles, completely hates it.
Wall Street has no patience for it.
None at all. But they aren't just going to burn that cash forever, right? There has to be a catalyst to change this dynamic.
There is. And this is the crux of the turnaround strategy detailed in the analysis. Management has realized that the consumer adoption of pure electric vehicles is simply not happening as fast as the industry initially projected a few years ago.
No, it's definitely slowed down.
Consumers have range anxiety, the public charging infrastructure isn't there yet, and EVs are just expensive.
Very expensive.
So what is Ford doing? They are actually adapting. They are actively throttling back their aggressive multi-billion-dollar EV rollout.
They're tapping the brakes.
Literally tapping the brakes. They are delaying battery plants and significantly reducing those massive capital expenditures.
And here's where it gets really interesting. Because while they throttle back the pure EVs, they are pivoting hard to meet the consumer where they actually are today.
Yes, the hybrid pivot.
They are leaning heavily into their hybrid lineup, which falls under their Ford Blue division. Consumers want the fuel savings of an EV, but the security of a gas tank.
You're right. It's the perfect middle ground.
And Ford is uniquely positioned to deliver that. And importantly, those hybrids are highly profitable for them right now.
Right. And to take that a step further, think about the mechanics of what happens next on the balance sheet.
Okay.
This is the true aha moment of the entire bull case in the report. You have this massive $21 billion operating cash flow engine.
Right.
Right now, it's being eaten alive by EV CapEx. But as Ford actively reduces that CapEx, and as the pivot to those highly profitable Ford Blue hybrids takes hold, that trapped operating cash flow doesn't just disappear.
It has to go somewhere.
It rapidly converts into free cash flow.
Wow. So the money literally stops going out the back door to build battery plants.
Yeah.
And it just starts piling up in the company's bank account.
Exactly. When the broader market sees that $21 billion operating cash flow violently convert into actual free cash flow on the balance sheet, the fundamental metrics will simply look too good to ignore.
The market won't be able to look away.
The stock will have no choice but to aggressively reprice upward to reflect that massive influx of unencumbered cash.
Okay, so you get paid 5% to wait for them to turn off the CapEx faucet, which immediately floods the balance sheet with free cash flow, driving the price up.
That's the thesis?
It sounds great in theory, but I know we have listeners who are cautious. They want to know about the downside.
Always good to look at the downside.
Right. They want to know where the floor is before they even think about the ceiling. What is the technical safety net here? Does the analysis report look at the stock chart and structural support?
It does, and it paints a picture of a severely de-risked investment at these current levels.
Okay, de-risked how?
If we look at the stock from a purely structural, technical standpoint, Ford has taken a massive beating since its post-pandemic peaks.
Yeah, it came down hard.
Remember, this stock was flying high at $25 plus just a few years ago when the EV hype was at its absolute maximum.
Everyone thought they were going to be the next Tesla.
Exactly. But since then, the hype has died, and the price has aggressively compressed downward, settling into a very defined long-term value channel.
Right, it's been pushed down into a very specific tight trading range.
Yeah.
So where is the actual hard support? Where do the buyers consistently step in?
The historical charts in the report highlight that the stock has repeatedly and successfully defended a critical macro support level right in the $11 to $11.50 range.
11 to 11.50.
Every single time market panic pushes the stock down toward $11, value buyers step in.
They scoop it up.
They recognize the deep underlying value, the dividend yield spikes to an irresistible level, and they defend that price floor.
So from a historical and technical perspective, your downside risk at $12.15 is highly limited.
Very limited.
You are sitting right on top of this massive proven support floor of 11 to 11.50. You aren't trying to catch a falling knife. You're looking at an asset that has already hit the floor and bounced multiple times.
That's the beauty of it. The downside risk is historically limited by that proven floor. But conversely, the upside potential is highly asymmetric.
Meaning the potential gain heavily outweighs the potential loss.
Precisely. The projections suggest that once management successfully caps the EV losses, reduces the CapEx, and that free cash flow narrative takes over, the stock has a very clear runway to return to its historical price to earnings, or PE, multiple of roughly 6x to 8x.
Which means the stock goes significantly higher from here.
Much higher.
So you have a defined limited downside of maybe $1 or so, and an incredibly elastic massive upside once the narrative shifts.
It is the definition of a margin of safety. You have the structural protection of the $11 support floor. You have the 5% dividend physically paying you cash while you wait for the turnaround. And you have the immense upside catalyst of the CapEx reduction combining with the Ford profit engine.
Okay, let's bring all of this together. So what does this all mean for you listening right now?
The big takeaway.
Right. If you take one actionable thing away from this deep dive, it is that the entire bullish thesis relies on your ability to look past the temporary self-inflicted wounds of the Model E division.
You have to look past the noise.
The broader market is entirely obsessed with the EV cash burn, but the underlying data proves that the burn is a strategic choice. And more importantly, it's a choice management is already actively reversing by pivoting to hybrids.
They are fixing the problem as we speak.
Exactly. At $12.15, you are not just buying shares in a struggling legacy automaker trying to figure out electric cars. You are buying a world-class, immensely profitable commercial business in Ford Pro at a remarkably deep discount with a 5% dividend yield attached to it.
I think this entire analysis perfectly illustrates the value of zooming out.
Absolutely.
In an investing world characterized by relentless information overload, algorithmic trading, and sensationalized negative financial headlines, true value is so rarely found by following the herd.
It never is.
It is found by looking at the unglamorous fundamentals, understanding the actual mechanics of the cash flow behind the noise, and recognizing when the market is emotionally mispricing an asset.
And they are definitely mispricing this one.
Ford is generating roughly $187 billion in real revenue and completely dominating commercial logistics, yet the stock is priced as if the doors are closing tomorrow. That emotional disconnect is exactly where the long-term opportunity lies.
It's all about looking where others aren't and being patient enough to let the math work in your favor.
Exactly right.
And that actually leaves me with a final, slightly provocative thought for you to ponder long after you finish listening to this deep dive.
I like a provocative thought.
Think about everything we just covered regarding Ford Pro and that sticky software ecosystem.
Right.
If Ford's true financial backbone, their most undeniable competitive moat, now lies in integrated telematics, commercial charging networks, and a predictive fleet services platform, rather than just manufacturing metal boxes for everyday drivers.
It changes everything.
Does that mean this century-old traditional Rust Belt automaker is actually evolving into a high-margin tech and logistics company hiding in plain sight?
It's a fascinating question to consider.
Think about that next time you see a blue oval driving down the road. Thank you so much for joining us on this deep dive. And remember, always keep questioning the headlines.
Don't forget to like, share, and subscribe for more.